Before you assume the rally is dead, understand this. What you just witnessed on the silver chart was not a collapse. It was a controlled detonation designed to flush out the weak before the next leg higher. I want you to pause for a moment and look closely at the chart in front of you. Not the numbers, not the headlines. Look at the structure. Focus on that towering vertical wick stretching above the candle body. That spike is not random. It is not a natural price discovery. It is evidence. It marks the exact moment the market lost control, if only briefly. Silver didn't casually climb toward the low 80s. It didn't grind higher over hours or days. It jumped. One moment the market was sitting comfortably below 80, and the next, silver had flashed above $83. That kind of movement doesn't happen in a healthy, liquid environment. That's not enthusiasm, that's stress. And just as quickly as it appeared, the move was erased. The price was shoved lower, violently, all the way into the mid-70s in a single session. A $9 round trip in hours. If you're new to this market, that kind of move feels like the end. It feels like the bubble just burst. It feels like confirmation that you were late, that the rally was a trap, that everything is over. But if you've lived through prior silver cycles, if you remember the shocks of earlier decades, you recognize this pattern instantly. This was not organic selling. This was a liquidation event. What you just witnessed was a precision strike against leverage. During thin holiday liquidity, when volume dries up and order books hollow out, price becomes fragile. The institutions know this. They watch it closely. When liquidity thins, they gain leverage, not with capital, but with timing. They allow prices to run just far enough to trigger excitement, just far enough to invite overconfidence, just far enough to pull in traders chasing momentum with borrowed money. Once that crowd piles in, the trap is set. Most short-term traders don't hide their exits. Their stop-loss orders cluster in predictable zones. Buy near 80, protect yourself at 75. That's where the danger lies. When price begins to slip, it doesn't fall smoothly, it cascades. Stops trigger more sales. Margin calls forced liquidation. Forced selling feeds itself. That is exactly what happened here. The sell-off wasn't driven by fear from long-term holders. It was driven by forced exits. And when price finally hit the mid-70s, something important happened. The selling stopped. Not gradually, immediately. Buyers stepped in with size. The same entities that allowed the run-up were waiting below to absorb the fallout. That's how leverage gets cleansed from the system. Now let's talk about the candle everyone is staring at. Technically, it's known as a shooting star or high wave formation, a small real body with an exaggerated upper wick. On paper, textbooks call this bearish. They say it signals exhaustion, but context matters. Pattern recognition without situational awareness is useless. This candle did not form after a long, aging up trend. It formed at the very beginning of a breakout during a low-volume holiday window. That changes everything. What it really signals is rejection of speed, not rejection of direction. Markets can move higher, but they cannot teleport without consequences. When they try, they snap back. That snap is not failure, it's digestion. After a move like this, consolidation is not just normal, it's necessary. The market needs time to absorb what just happened. Here's the key detail most people are missing, despite the violent drop from the highs. Silver is still trading significantly above last week's close. Strip away the spike. Ignore the wick. Look at where we actually are. This is still a strong green move on a higher time frame. The trend did not break. The breakout did not fail. What ended was the easy money phase. From here on out, gains won't come quietly. They will come through volatility. Now compare silver's behavior to gold. Gold barely moved. While silver was whipping back and forth, gold sat calmly near record highs. That contrast is telling. It tells us the monetary signal is intact. Gold is the anchor. As long as gold holds firm, silver's floor remains supported. Silver simply expresses stress more violently. It's high, beta metal. It overshoots. It snaps back. That volatility is not a flaw, it's the cost of participation. And that's where the difference between paper traders and physical holders becomes crystal clear. If you were holding physical silver during this move, nothing about your reality changed. Your metal didn't disappear. Its utility didn't decline. An ounce didn't become less useful because a screen flashed lower numbers for a few minutes. Physical holders watched the chaos, shrugged, and moved on. Paper traders, on the other hand, felt every tick. And that brings us to the most important divergence of the entire session, the disconnect between paper price and physical reality. When spot prices briefly plunged into the mid-70s, did coin shops slash their prices? Did premiums collapse? Did dealers panic and dump inventory? No. In many cases, premiums stayed elevated, or even increased. That tells you everything you need to know. Dealers understand volatility risk. They know that selling physical metal into a whipsawing paper market is a losing proposition. They price for stability, not for algorithmic chaos. The fact that physical pricing remained firm proves that the drop was synthetic. It was not driven by real supply entering the market. In genuine bear markets, physical selling appears. People line up to liquidate. That didn't happen. Instead, physical supply remained tight. The dip existed almost entirely on screens and for minutes, not days. Industrial buyers noticed. If you were responsible for securing silver for manufacturing solar panels, electronics, energy systems, that brief drop wasn't scary. It was an opportunity. It allowed hedging at a discount. It allowed inventory acquisition at lower levels. Those buyers don't chase spikes. They wait for forced selling, then step in decisively. That's why the bounce was so sharp. This wasn't retail saving the price. This was industrial demand absorbing liquidation. That creates higher lows. Last week's floor sat much lower. This week's floor is higher. That's how uptrends are built, not with straight lines, but with staircases. Volatility, in this environment, acts like a tax. But it's not a tax on ownership, it's a tax on leverage. If you were wiped out, it wasn't because silver failed. It was because your position size exceeded your tolerance for randomness. Physical holders paid nothing. In fact, they gained information. That brief surge above $83 revealed something critical. It showed where price wants to go when suppression loosens, even momentarily. Think of it like pushing a beach ball underwater. When your grip slips, the ball doesn't rise gently, it explodes upward. The snapback doesn't mean the pressure disappeared. It means the pressure is building. Now let's talk about market structure. This move didn't correlate with currency shifts. It wasn't driven by macro news. The dollar didn't collapse. Interest rates didn't change meaningfully. This was an internal event, a rebalancing of positions that had become too one-sided. That's actually constructive. Had silver marched straight toward triple digits without interruption, the eventual correction would have been devastating. Instead, leverage was flushed early. Open interest was reset. The runway was cleared for capital that operates on monthly and yearly horizons, not hourly ones. Which brings us to the calendar. We are approaching a critical monthly and yearly close. If silver holds above the mid-70s into the end of the period, it will mark the highest monthly close on record. That signal dwarfs any single daily candle. Long-term capital responds to those closes. Pension funds don't care about intraday spikes. They care about structural confirmation. From their perspective, the recent drop didn't signal danger. It signaled a discount. Algorithms, however, respond differently. They hate volatility. When daily ranges explode, risk models shrink exposure. That's why we may see choppy, sideways action in the near term. That chop isn't random. It's designed to frustrate momentum traders and drain option premiums. This is the boredom phase, and boredom is where trends survive. As price consolidates, those who chase highs lose interest. Those who wanted instant gratification move on. That's when stronger hands quietly accumulate. Gold stability reinforces this backdrop. If the broader monetary thesis were failing, gold wouldn't be holding its ground. The fact that it is tells us silver simply moved too fast, not too far. Now consider producer behavior. When markets become unstable, miners don't rush to sell. They delay. They reduce hedging. They wait for clarity. That removes supply precisely when demand is firming. It's a subtle shift, but it matters. At the same time, physical inventories bear watching. If price declines while metal leaves vaults, that's a bullish divergence. It means real demand is overwhelming synthetic pricing. Early signs suggest that's exactly what's happening. Layer in geopolitical uncertainty, year-end risk aversion, and the growing appeal of assets without counterparty risk, and it becomes clear why downside pressure keeps finding buyers. There's also a psychological shift underway. At higher prices, silver stops being viewed as a cheap curiosity and starts being treated as a serious monetary and industrial asset. That change in perception attracts larger pools of capital. Higher prices expand the market's relevance. This is reflexivity at work. Rising price validates importance, which attracts capital, which reinforces price. So what now? Expect more chop. Expect attempts to pin price into year-end. Expect noise. But understand what matters. Structure trend, physical demand, monthly closes. This was not a top. It was a test. The market tested higher levels. It tested lower support. It learned where real buyers exist. That knowledge strengthens the trend. If silver were weak, this event would have broken it. It didn't. Instead, it flushed excess, hardened support, and revealed latent demand. That's not bearish. That's preparation. The move above 83 didn't fail. It left a marker. Markets love to revisit those markers. When they do, conditions will be different. The sellers who acted this time may not be there next time. The path forward won't be smooth, but the direction remains clear. Volatility didn't kill the trend. It confirmed it.